past performance is not a reliable indicator to future returns, Declan. Before I go off on one, what's your view of that regulator sentence?
Well, as you said, it's a regulatory statement that we have to put in all our documentation. But actually, it goes fundamentally to our wiring as humans. We like to see patterns in things. So the recent past is going to be what happens in the future. We extrapolate that as if somehow it's a kind of life is easy. We try and simplify things down. So the roaring S&P and the AI stocks are going to outperform because they have done. But actually, we've seen from a variety of data and actual evidence that is a misnomer at best and fallacy at worst. So it's not just a regulatory statement, it's true in reality. But actually, we have to acknowledge why people cling on to that, because it's easier to think that way.
Yeah, that's absolutely accurate. And of course, I have a famous phrase, isn't it? Don't look at the squiggle. And that plays into your behavioural psychology argument there, that people want to see the squiggle clearly continuing, which is natural, but they assume because the squiggle behaved like it did yesterday, it's going to behave like that tomorrow.
Yes.
And it's interesting that it seems to be the only part of life, investments, where people think that because it happened yesterday, it's going to be the same tomorrow. They would never, ever view that when it comes to any sporting example. Just because a football team wins yesterday doesn't mean they're going to win tomorrow. I mean, the evidence to support that is overwhelming. And yet, in terms of investments, people think that's happening. So why do you think
Well, people like to buy into success stories. There's also a fear of missing out, the FOMO of that piece as well. So it actually feeds into things that got expensive. If you think about it logically, things that are expensive are less likely to go up again because they're highly valued, they're expensive. Quality things that haven't gone up as much are more likely to outperform. And you might go, that's very theoretical, but what happened in 2025? Things, sectors, economies and stock markets that were less highly valued, less filled with hype, outperformed. So your narrative of past performance at the beginning in January 2025, you would have just gone into the US, large cap stocks, with nothing else, because that's what's outperformed previously.
So clearly you and I are quite adamant about this, that past performance isn't an indicator, or reliable indicator, I should say, about the future. But is it completely irrelevant?
I don't think it's entirely irrelevant, because you've got to understand why the performance happened. Because sometimes things go up for irrational reasons, and actually the drivers of those return wasn't what people supposed at the beginning of the period. So it's, we don't ignore it. However, you've got to look at a much broader picture rather than your squiggle.
So understanding the reasons for performance or returns, and indeed losses, that is a fair analysis. Identify what the causes were for either positive or negative, that's the learning point. Now, of course, it's important not to then assume that those will repeat either.
No, you've got to be cognizant of the environment from today and the forward-looking period. So because they might not repeating what they were in the past.
So when people watch us discuss this subject, they're probably looking at us going, yeah, you would say that, wouldn't you? So why are we so adamant that really past performance, yes, okay, is a potential relevant subject that people should consider, but it's certainly not at the top. It's certainly not the priority one. Why should people agree with us?
Because if you go down that narrative, that leads you to a very kind of concentrated portfolio. That leaves you to a lot of inherent risks there, which can blow up on a very quick basis.
So I bought the 7 fan mags last week. I'm going to buy them next week.
And suddenly 4 of them are out of favour.
Yeah,
which has happened in the recent past as well. So all that narrative about, I want to simplify everything, I just want to buy what's gone up in the last 2, 3, 4 years, doesn't pan out. Now, what clients of their financial advisor will have is somebody to kind of talk them through what actually happens and be diversified to avoid that chasing past performance.
So what do we do then? How do we use past performance? Because we've agreed that past performance isn't the be-all and end-all on one extreme, but we've also agreed that it's not irrelevant. So how do we use it? How should investors think about it and use it?
Whether you think about it from the broad base of asset classes they've invested within, why things reacted the way they did,
Yep.
and actually much broader going forward, is that still the environment that they can lend itself to higher returns?
So really, the only conclusions they can draw from it is the fundamentals, really, that you need to be diversified across whatever appropriate asset classes for their risk, and you need time in the market.
Absolutely.
If you're trying to force either of those rules, well, I suppose the technical investment phrase is you're going to come a cropper.
Indeed.